Welcome back, everyone, to Alpha Beta Soup. I'm TXMC. Today is a busy schedule. This is a week full of monetary policy news. Yesterday, we had an FOMC. The Federal Reserve raised their target interest rate 75 basis points, as we expected. We will dive into that. We will talk about the press conference. We'll look at some of Powell's comments in response to questions from it. Much to look at there. This morning, the Bank of England raised their target rate also by 75 basis points in line with the Fed. And in addition, something that really caught the market off guard today, they now expect the longest recession in UK history. The Bank of England is projecting an 8-quarter long recession. That's 2 years starting now. You won't find that kind of honesty out of the Fed, I'll tell you that. So we'll talk about all these policy decisions and the path ahead for the economy in today's video. Don't go anywhere. If you enjoy this content, please give this video a thumbs up and subscribe to my channel. All of your support helps me continue to do this work, so thank you very much. We have much to discuss, so let's get into it. Yesterday was FOMC day, and as it has been throughout the year, it was full of drama and the markets whipped around. The Federal Reserve raised its target interest rate by 75 basis points, which is what the market expected. It's what we talked about on this channel. And it was the comments of Powell in the press conference that really got the market chopping around, as is typical of FOMCs this year. We'll spend some time a little bit later looking at the press conference because there's some comments in there I want to dig into. But first, let's level set with equities. So in the previous video, we talked about how I thought maybe the rally in the S&P and the Dow Jones was running out of steam. We saw the S&P reaching this resistance area here, which is in the center of a larger range that it's been established over the last few months. It's about smack dab in the middle of it. And when we looked at lower time frame RSIs in the previous video, we looked at 1 day, 8 hour, 4 hour, all of them looked a little toppy. And that was happening at the same time that the Dow Jones over here was reaching its own levels of resistance. Now it actually got higher up. The S&P for its part is down here relative to itself, but the Dow went further. It's actually up in this area, which for the S&P would be up here. And the Dow also reached its 200-day moving average, which it has been rejected at a couple of times already, and it's now there again. So when I saw this confluence along with the S&P at its own little resistance area, RSI for both of them looked kind of toppy. So in the last video we talked about, I think maybe the rally could be running out of steam. This looks like a good place for it to maybe gather support. Perhaps it does move higher again, but this seems like a place to slow down. We did get that action precisely, and it was starting to develop before yesterday's press conference, but the FOMC really accelerated the downturn, and I think it's obvious now that the rally has run out of steam. Bitcoin has not done a whole lot. It is following equities directionally. You can see that, but the beta is smaller, and relative to itself, volatility has been falling. That's something we explored a couple weeks ago. Most of the action is in equities right now. There isn't a lot of speculative spillover into what's going on with Bitcoin. So that's why our focus has been the equity markets. So the Fed raised its rate yesterday by 75 bips, which is exactly what the market expected. We've been looking at this chart a few times here and there throughout the channel. This represents all of the Fed funds futures contracts between now and the end of next year, monthly. Currently, the Fed funds rate, as it's listed on TradingView, is still showing down here at the October level, which is also aligned with the end of the October contract in this yellow line. That ended 3 days ago. The Fed funds rate just got raised, however, up to this point. We're actually here now, and it just hasn't updated in TradingView. But this is exactly what the market had priced in for the month of November. You can see this is the Fed funds futures contract. It's been up here since the middle of September. This is where they thought the terminal rate would be. So the market got exactly what it expected yesterday. As far as what it thinks for December, it's looking like we're going to have another 50 bips. January, another 25. And then after that, it gets a lot more uncertain. This is the rest of 2023 all clustered together up here around 5%. We'll look at this in a different way here in just a moment. But what I really want to point out is that the market knew that this was coming, yet we still got a massive flush yesterday. Part of that is because of what Powell said in the press conference. Some of his answers to the questions from reporters got the market a little more uneasy, and it caused more of a flush. We'll talk about that here in just a second. Now, this view here is all of those Fed funds futures curves. So here, all these lines you see chopped up, this is them represented individually. Up here at the top, you see the contract that they represent. Now, I have the dates on here starting at the beginning of this week, October 30th. And you can see many of these rates have moved higher from where they were just at the beginning of this week, largely because of what happened at FOMC. And now the terminal rate has moved up from where it was around 5%. Now it's up near 5.25%, and it's ending around July. According to Fed Funds Futures, it looks like the peak of terminal rates is in the middle of next year. This is a moving target, though, and this is not a prescription for the Fed. This is what the market is expecting to happen based on current information. This is what they're able to price themselves into. And really, just looking at the rise in these rates is remarkable. Let me go back a few more weeks. Let me go back to the beginning of October. Look at how these have changed. We were down around 4.4% at the beginning of October, October 2nd, for most of these curves well into next year. And just in the month of October, all those expectations got dashed higher by almost a half percentage point, many of them more than that. And now the curve that was down here around 4.5 is topping around 5.25. Huge move just in a period of 30 days, which makes predicting the path of Fed funds extremely difficult on any time horizon more than a couple of months. So I just thought this was kind of a remarkable view, and it gives you a sense of where the market thinks that rates are going to go based on today's information. And they're thinking 5.25%, which is almost unfathomable. If you had asked me 6 months ago if I thought we would see a 5% Fed funds rate, I would tell you no fucking way. But here we are, the market is pricing it in, and the Fed is marching towards it, and we may actually get there at some point. It's an open question whether the economy can operate and whether the government can continue to fund itself with 5% base interest rates. We will find out. I remain incredibly skeptical about the ability to do that, but that doesn't mean the Fed can't hike us to that rate level and try to keep us there for a little while. It's just that the economy and the government may not tolerate it for very long. We will have to see, but it is remarkable how resilient the economy has been this year. The data looks terrible. There is clearly economic weakness underneath the surface, but because of the amount of money printing that happened over the last 2 years, there's a lot of liquidity sloshing around in the system, not just in the banking sector and in the financial sector, but also in corporates, in households. The labor market also shows a lot of tightness. There is heat in the economy, even though we're looking at all of these economic indicators that are screaming weakness and slowdown and recession. It's making this year very difficult to read, not just for me, but for traditional economists. Everyone's models have been shattered, and the sequence of events over the next few months are a complete mystery to most of us. We can make educated guesses, but there's really no historical analog for this exact mix of criteria that we have right now. And it was yesterday during the press conference that markets really began to eat shit. You can see that right here. There was a pump into the beginning of the FOMC, and then when Powell started answering questions, the market tanked hard. The S&P looks just like this. This is the Dow Jones on a 15-minute chart. So let's look at a few of the things Powell said in the press conference that got the media's attention. So here we are at the FOMC press conference yesterday. Powell is reading from his prepared remarks. He isn't taking questions yet, and something he read here near the end of the statement got the media's attention. So let's listen in.
As I've said in the last two press conferences, it will become appropriate to slow the pace of increases as we approach the level of interest rates that will be sufficiently restrictive to bring inflation down to our 2% goal.
So first, he said it will be appropriate to slow the pace of increases. You and I know that. We've been talking about that. That's the Fed Funds Futures curve that we looked at over here. The market priced in the expectation of slower hikes. It thinks December will be 50. It thinks January might be 25. Obviously, these are up for change. They're up for debate. This is a moving target. But the market already expected a slower pacing of hikes. So when the media got really excited about that wording, you and I and those of us who look at this kind of data knew that the market had already anticipated that. But that wasn't the real kicker. The real kicker is right here.
There is significant uncertainty around that level of interest rates.
So he says there's significant uncertainty around the level, the terminal level of interest rates. There's still a lot of debate within the Fed about what the terminal final rate should be.
Even so, we still have some ways to go. And incoming data since our last meeting suggest that the ultimate level of interest rates will be higher than previously expected.
Right there. Data since our last meeting suggests that the terminal rate will be higher than we previously expected. So what has happened since the last FOMC? We've gotten two different reports specifically that I think caught the Fed's eye. One of those reports was CPI. It came out a couple weeks ago. You may recognize this chart. We looked at it in the video 2 videos ago. This shows the CPI basket month over month, and it's from July to August and August to September, and we saw broad gains in the CPI basket, and things that had pulled CPI to a more neutral level in August were pushed higher in September. Energy was weakened, commodities were weakened a little bit, and there was broad gains across the core pieces of the basket, namely in services. We will get another CPI report a week from now on November 10th, exactly a week from today, and we'll find out if this trend continues. I imagine some of the services sector inflation will remain sticky and elevated. Something else that came in was the JOLTS report, the labor turnover survey, and that showed a rise in job openings. So here are job openings in this black line. The red bars represent the month-over-month change of job openings. And what happened to surprise the Fed was a jump higher in job openings. This is the wrong direction for what the Fed is trying to accomplish. They want there to be fewer job openings because the Fed believes there is a pathway to achieving a soft landing where they cause a fall in job openings. Because what this represents, guys, when you see a lot of job openings, that represents labor demand. That represents businesses wanting to hire more people. They're trying to get more labor to come work for their business. And this is not the direction that the Fed is hoping the economy will go. The Fed is hoping that the economy will begin to soften so that they don't have to keep raising interest rates. And when you see outsized labor demand, where it is not softening from its historical highs, it shows that there's still a lot of resiliency in the economy. Businesses are not cutting back in the way that we would expect them to. In fact, they're still trying to hire more people. And this is a weird dynamic because we're hearing news stories about various big tech companies laying people off, right? We've heard a lot of those stories over the last couple of months. Yet still, overall national labor demand remains outsized, remains historically outsized. And if you compare this number here to the number of people who are officially unemployed, it's still 2 jobs for every 1 person. So the Fed does not like seeing a higher jump on job openings. They expected this to continue falling, not to see another 437,000 jobs being asked to be filled. So this, combined with the CPI report, suggested to the Fed that interest rates will need to be higher than where they were previously. And that's why Powell said what he said. A couple minutes later in the press conference, Powell is now answering questions. And one of them is, are you biased towards having lower rate increases at future meetings? There's a lot of focus in the media around a slower pacing of hikes, about them not raising 75 every time. And there's almost like this inexplicable, weird hope that that is somehow bullish, that that constitutes some kind of a pivot. And it absolutely doesn't. I'm telling you, it doesn't. But somehow the market is glomming onto that because they're just utterly beaten down. Sentiment is in the gutter. People are looking for a ray of hope, and they're still clinging to this idea that the Fed will backstop the markets. But Powell is going out of his way to explain that that isn't the case, which is pretty interesting in and of itself. But right here, Powell, in the process of answering the question about whether or not they're going to slow hikes, and he basically says yes, at some point in the future we will raise less than 75, but it's dependent highly upon data. He also says we've raised extremely aggressively this year, so we shouldn't be focusing so much on the fact that the next hike might be slightly less. We went from basically 0 to 400 basis points in like 6 months, which is historically aggressive. And that's his point here in this long answer that I'm not going to play for you guys. But he gives a detailed answer, basically saying, let's not focus on the pace. What's more important is how high we must go with rates. And there's still a lot of debate about that. And then right here, he confirms what we just said, that the CPI report and the job openings report caught their eye and told them rates need to go higher.
And as I mentioned, incoming data between the meetings, both the strong labor market report, but particularly the CPI report, do suggest to me that we may ultimately move to higher levels than we thought at the time of the September meeting.
See, he's basically telling you the data is getting worse as we are hoping that it gets better, and it's forcing us to extend the runway of our plan. Obviously, we are suspending belief about whether or not they will continue this well into next year and achieve their multi-year higher for longer plan. I remain very dubious about that, but right now they are attempting it. They will be able to pull it off for some amount of time that is uncertain, and until we get to a breaking point, we have to deal with these conditions. So it's important to talk about them. The next question is from the same reporter, and he follows up. I'm not going to play his question because he takes him a minute to get there. Powell is asked here, do you feel that because of the amount of stress in the economy, the amount of media focus globally on your policy decisions, do you feel that it's necessary that you provide ample warning ahead of time before you make any decisions? Do you feel like you have to warn the market over and above what you normally would?
I think I'm pleased that we have moved as fast as we have. I don't think we've over-tightened. I think there's very difficult to make a case that our current level is too tight, given that inflation still runs well above the federal funds rate.
So basically, he goes on and he says a few more things, but his answer is, look, guys, the economy is still hot. We may be seeing recession indicators, but there is still outsized labor demand. There is still accelerating core inflation, and we're just not seeing the kinds of markers that would indicate to us that our policy stance is sufficiently restrictive to cool the economy off. They're not seeing it yet. A bit later in the press conference, Powell is answering a different question about what they think the lags are like in their policy and how they affect the economy. And he's explaining about how when they raise interest rates, it takes several months for those things to work their way in. It's really uncertain and imperfect how they measure those things. And it's just important to be patient, not to think that just because they get one positive reading in a direction they're hoping for, that doesn't necessarily mean the trend has changed. And he said this piece right here that I think is one of the kickers of the whole press conference.
Let me say this. It is very premature to be thinking about pausing. So people, when they hear lags, they think about a pause. It's very premature, in my view, to think about or be talking about pausing our rate hike. We have a ways to go.
So he said it is very, emphasized very, premature to be talking about pausing interest rate hikes. So he just threw cold water on all of the bullish sentiment that could possibly be gleaned from this press conference. Just like we experienced in July, where the market thought what Powell said was bullish, and he came out and said, no, guys, you're wrong. This is not bullish. He's having to do that again. And this is what the remarkable thing is about this, guys. Because of the low interest rate policy that we had for all those years following the great financial crisis, because of the excessive amount of QE, because of the amount of money printing, because of the Fed policy response to market turmoil over the last 10 years, and how they have consistently backed off anytime the market has shown weakness, those have built in a Pavlovian response within investor behaviors, where they expect that the Fed will rescue them, where they don't think the Fed is willing to stomach a market crash. How can you blame them? That behavior has been reinforced year after year after year. And now the Fed is having to do work this year to break those norms, to shatter those stereotypes. They may not ultimately be successful, but they are currently trying to do that. And it's a really volatile and painful process. And throughout these last few months, any one of you who've been watching the channel, we've been going through this roller coaster. We've been watching these press conferences and picking them apart. And time after time, the market misinterprets what he says as some kind of a bullish surprise, some kind of secret bullishness. And every time they've been wrong, and Powell has had to come out and emphatically shut them down. Now, a bit later in the press conference, Powell is asked about this news story that came out about a month ago, where a United Nations Council basically put out an open letter to the Fed and other central bankers asking them to stop raising interest rates or they risk a global recession. Kind of a remarkable comment out of the UN. They don't normally make direct pleas to central banks, but the Fed was asked in this press conference right here if they cared about that message, if that was something that they factored into their plans, into their strategies. And Powell said a couple of things here that I think is remarkable.
So we see those difficulties. The strong dollar is a challenge for some countries, but
The strong dollar is a challenge for some countries. You want to talk about an understatement. Over half of all commerce in the world is denominated in US dollars. Many nations have more than half of their imports denominated in USD, even if the United States is not one of their major trade partners. Over 60% of all world currency reserves are held in dollars. Our debt is the most proliferated debt instrument in the world, our treasuries. The dollar is everywhere. To say that a strong dollar is a, quote, challenge for some countries, unquote, is an exorbitant understatement. And I thought that was a little funny. But basically, the Fed doesn't care what the UN says.
You know, we take all of that into account in our models. We think about the spillovers and that sort of thing. Here in the United States, we have a strong economy, so we know that we need to use our tools to get inflation under control. The world's not going to be better off if we fail to do that. That's a task we need to do. Price stability in the United States is a good thing for the global economy over a long period of time. Price stability is the kind of thing that pays dividends for our economy for decades.
So he thinks that they need to focus on the United States economy. And I agree. Their mandate is not the world. Their mandate is price stability and full employment in the United States. So I am in agreement that they should focus on the U.S. economy. But I think it's interesting how they point out that by focusing on the U.S., myopically, that will reap benefits for the rest of the world. And that is a sentiment I do agree with. And I think it's interesting how he was open about that here, basically saying, look, sorry, United Nations, I know you guys are having some trouble, but that's not really our focus. We think by not seeing our task to completion, whether or not they will be successful is another story, but they believe that by seeing their task to completion, they will be providing benefits to the rest of the world that uses our currency. So basically, cold water thrown on whether or not the UN's message even matters to them. Here we have arrived to maybe my favorite moment of the press conference. This gentleman here incorrectly points out to Jerome Powell that the market is responding positively to the press conference so far. We could look over here and you could see how maybe he would have been confused, right? This was the movement earlier that day, but by the time he asked this question, we were really actually about right here. So he was not correct in saying that the market was reacting positively. It had already turned over. But regardless, he says to Powell, the market seems to be reacting positively to your words so far. What do you think about that?
And just a quick follow. It looks like stock and bond markets are reacting positively
Watch this guy's face right here.
Your announcement
Watch
so far.
this guy.
Is that something you wanted to see? Is that a problem or?
This guy right here. Yes. Ask him about the stock market. That's what I want to hear.
How that might affect your future policy to see this positive?
I won't play Powell's entire response to the question because it's quite lengthy, but basically, Powell lists half a dozen reasons why the market is wrong. Plainly, he says, look, guys, inflation is still rising. It has not shown any abatement. There is still outsized labor demand. There's still 2 jobs for every unemployed person. There is still a lot of heat and tightness in the economy broadly, and they have seen no reason to back off of their plans. If anything, they have been encouraged to keep going. As he said earlier in this press conference, rates will now have to be higher than they were thought to be at the September meeting. So if anything, this process is being extended, not shortened. And so the market is dead wrong if they're jumping to conclusions about a pivot. That's essentially what he says here. He threw cold water all over the market, and that at the same time is when we got this massive candle right here, this one. And so after that, it was just lights out, and the market didn't recover from that. It took out the day's lows, and it was over after that. The last part of the press conference that we'll look at is the final question. And he's asked, is the window for a soft landing narrowed?
I'm wondering, has the window for a soft landing narrowed? Do you still think it's possible?
Has it narrowed? Yes. Is it still possible? Yes. I think we've always said it was going to be difficult, but I think to the extent rates have to go higher and stay higher for longer, it becomes harder to see the path.
He spends a couple of minutes answering this question, but his short answer is yes. The path for a soft landing has narrowed, and it's become increasingly complicated because of inflation specifically, because they would have expected by now inflation would have subsided, and it hasn't.
The job losses may turn out to be less than would be indicated by those traditional measures because because job openings are so elevated and because the
So they also think that because there's so many job openings, which is this chart we looked at right here, all these job openings, because of this, they think that their tightening will cause this to be the release valve rather than currently employed Americans. This is one part of labor, right? And then there's also a bunch of people who have jobs currently filled. These are jobs trying to be filled on top of that. And they think that they can cause this number to come down without creating the kind of joblessness that we normally see in a recession, because this is historically elevated. That's the pathway they think that they're targeting. Whether they're able to achieve it or not is anyone's guess. We won't know until we get there. But this is why they think that it can continue tightening and that it won't be quite so bad, that it's a kind of recession that they can recover from. And Powell has made it clear they believe in the power of their tools. They believe that the risks are in them not tightening enough, not in over tightening. They believe that no matter how deep a recession is, that they can buoy the economic recovery with their tools because they did it in COVID. They think that they can do it again. And it shows a level of hubris about the power of their tools that I think is dangerous. And it risks a much worse recession because they're betting on this kind of pressure being released without creating mass joblessness at a period with record debt. I think they're really dancing with fire here. And it was a remarkable press conference to watch because Powell was doing this verbal waltz between trying to not be scary, but also trying to be scary at the same time. You know, there are a lot of people who think Powell is an idiot, that think he doesn't know what he's doing. And I'm here to tell you that those people are flat out wrong. You can disagree with his policy choices. You can think that they've made errors, and that is extremely valid. I think that there's a lot of misunderstanding about the complexity of his job at this particular moment in history and how difficult it is to try to keep the wheels on a $30 trillion economy when it's facing the kinds of challenges the U.S. is facing. And there's a presumption of simplicity in people who claim that Jerome Powell is an idiot. And the last couple of days have really been remarkable for the markets. To see them pumping into the FOMC yesterday, to see Powell remarking on the market action in the press conference and giving reasons why the market was wrong, all of that was astounding. There will be tomes written about this era of monetary policy, about the post-pandemic era and the response of central banks to the recession that was created by shutting down the global economy and all of the knock-on effects we are now experiencing as a result. This is a period of time that many, many books will be written about. And, I'm glad that we're here talking about it together and trying to make sense of it. So as we look out across the markets, it's kind of a mixed day today. Bitcoin is slightly green, but equities are red. The markets are still in recovery mode from yesterday, and today and tomorrow will probably not be as dramatic, not be as exciting. But the Bank of England also raised their interest rates 75 basis points today in response to the Fed. And in addition to the raising of rates, they also project a recession lasting 8 quarters and beginning now, with the assumption that monetary policy follows the path it has laid out for itself. That's not the kind of language that you will normally hear out of a central bank. Andrew Bailey and the BOE have been more honest with the public than we are accustomed to hearing, but the Bank of England is telling us a recession is coming. We expect it to last for 2 years, and if England goes through 2 years of recession, the US won't be far behind. So that is where we will leave things today. I mostly wanted to talk about the FOMC and the news that came out this week. We're still a long way from the end of this saga, and it can end in a couple of different ways. One way, which is probably the least likely scenario, is one where inflation magically starts to cool off, job openings start to ease and come down, people don't lose their jobs, and the Fed decides at some future date that they can back off of raising interest rates and actually begin to cut rates and start to encourage growth in the economy. We are a long way away from that. That kind of an outcome would take more than a few months to develop. It would probably take beyond next year to truly develop because it would require an easing of tightness on the supply side of the economy. As businesses are shutting down because of shortages, as energy remains in tight supply, those things underpin inflation. And as soon as we get growth in the economy, it will aggravate those factors and make prices go up again. We're not encouraging the expansion of supply. We are only attacking demand. So I think that outcome, that Goldilocks outcome, is the least likely scenario. What is probably much more likely is that the Fed will continue marching forward in this same manner, and that at some point in the future, either the Treasury market or the economy broadly will simply fold in on itself due to its inability to fund itself. The Treasury market is seeing some record levels of illiquidity and volatility, and that is a place that must remain functional for the ongoing health and existence of the global economy. It has not broken yet. It has been stretched to its limits, but it has not broken, though I think that sometime in the next few months it will. We'll continue observing the data, watching it as it unfolds, and trying to navigate through the murk until we start to see that singularity approaching. But I believe we've got many more months of this saga to play out, barring some unforeseen disaster that accelerates the process. Make sure that you follow me right here on Twitter at TXMC Trades. This is where you'll find a lot of my charts and analysis that ultimately make it into the videos. I also encourage you guys to check out my newsletter at alphabetasoup.io. You can find a link in the description to this video. You can also find it as my pinned tweet on Twitter. I started this newsletter a few weeks ago. There's another issue coming out here in the next week, and this is a place where I share a lot of my longer form ideas. I share bigger versions of my charts. There's also interactive versions of them if you want to be able to mouse over and explore them yourselves. That is for premium subscribers. This is my attempt to turn this into a career. I appreciate any support you're willing to give me. But either way, we'll keep making these videos and talking about the economy together. So until the next time, give yourselves a couple of days to cool off, make some plans for the weekend, try to get outside, and we will talk to each other in just a few days from now. So until then, take care of yourselves, friends. Take care of each other, and we will chat in the very near future. Cheers, everyone.